This video will help you understand net income attributable and how to do its calculation. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. If you discover that you made excess contributions to a retirement account of some kind at some point during the tax year, you'll need to do a net income attributable calculation. Generally, these are found sometime in April when filing your tax return for the previous calendar year, when you discover either you made too much money to make the contributions you did to a Roth IRA, for example, or you weren't watching how much you were putting into your retirement account and you made an overcontribution. The IRS says you'll need to withdraw any excess contributions plus any growth attributable to those excess contributions, and for that, they quantify that growth using net income attributable. So today, we'll walk through a few examples and explain how this calculation works so you can stay in the IRS's good graces. So let's jump in. Although it kind of sounds like it, net income attributable is not just a fancy made-up financial term in order to confuse clients and to increase my job security, although it does a great job of both of those. Net income attributable refers to the IRS's defined calculation for how to quantify the growth inside of one's retirement account solely attributable to excess contributions that never were supposed to have been made anyways inside that retirement account. Basically, if you're trying to correct any excess contributions you made to a retirement account before the tax filing deadline, it's not good enough for the IRS for you just to withdraw those excess contributions. Because theoretically, especially if the markets were performing well, you will have benefited inside your retirement account with some growth due to those excess contributions. The IRS wants you to withdraw those excess contributions plus that growth. Now, if you're past the tax filing deadline of April 15th, or you filed an extension and now we're past the October 15th tax filing deadline, well, you don't need to worry about the net income attributable calculation anymore for the previous calendar year because you are already past the fix-it period and you will now owe the IRS an overcontribution penalty of 6% on however much money in excess you funded into your retirement account. You now don't have to withdraw the excess plus the growth. You just have to withdraw the excess. But now you instead have to pay an IRS tax penalty. To avoid any IRS tax penalties, you're going to want to correct your overcontribution by withdrawing the excess and the growth by either April 15th or October 15th if you filed an extension. This is also a super common problem, so if you run into this, please know you are not alone. It's super common to accidentally overcontribute to an IRA. In fact, I made an explainer video of common situations where this happens all the time. Although it's not as common, it still does happen within employer-sponsored plans like 401k plans, even though generally there's a third party auditing who is putting in how much, called your third-party administrator. But overcontributions into those accounts happens too. And I'll link above to an explainer video on that. The most common situation where overcontributions occur is when somebody made contributions to an employer plan that they worked at for one part of the year, then they moved companies and made extra contributions to that new retirement account. And in total, they put in too much into a retirement account. That happens quite often. And although today's video is focused on doing the net income attributable calculation, please know that in order to be in the IRS's good graces, you have to withdraw both your excess contribution plus the growth on that excess contribution called net income attributable. Excess plus net income attributable. Now, before we get into the math, however, please know that you could have a negative net income attributable. For example, if the markets took a huge dump after you made an excess contribution, well, you've got a positive excess contribution, but you might end up with a negative net income attributable. And as we all remember from Mathematics 101, if you add a negative number to a number, then you're essentially subtracting that number. So in that example, and we'll cover a real world example of that in a second, in the real world, your excess contribution might actually just be reduced because the net income attributable is a negative number. So your total amount to be withdrawn could actually end up being less than the excess contribution you made. Therefore, before you run out and withdraw your excess contribution, then go do the net income attributable calculation, you're going to want to do the calculation first to determine the total amount to be withdrawn. Without further ado, let's jump into the math. The net income attributable equation is defined as excess contribution amount times the difference between your adjusted closing balance and your adjusted opening balance divided by your adjusted opening balance. To quickly define terms, adjusted opening balance refers to the fair market value of your account prior to any excess contributions, which simply defined is ideally the balance of your IRA or retirement account the day before you made an excess contribution to it, plus any excess contributions made throughout the computation period. The computation period is the time in which an excess contribution was first made to the time in which you're correcting your mistake. The balance of your account the day before an excess contribution was made, plus any excess contributions made until the day that you were correcting your mistake. The adjusted closing balance, on the other hand, is the fair market value of your account, or the value of your retirement account, on the day in which you are fixing the overcontribution, aka the day you're doing this calculation, plus any distributions or transfers out of the account that have occurred during that computation period. So if you made an excess contribution in January and in June you moved $1,000 into a different account and you're doing this calculation in December, well, you'll need to add back in as an adjusted closing balance the $1,000 that you transferred out of the account. Sometimes you'll see the net income attributable equation defined as excess contributions times the total earnings, and you divide all of that by the adjusted opening balance. Obviously, both equations equal the same result, but I have found that the first equation is a little bit easier to understand and easier to audit, in my opinion. Both equations obviously work, but I'm going to use the first one for these examples. Let's use an example individual who in 2025 is on track to make $100,000. Therefore, they're totally within their rights to try to fully fund a Roth IRA. Let's say they're under 50, so their maximum is $7,000. Let's say on January 1, they open up a new Roth IRA and they start making monthly contributions of $1,000. But let's say they forget to shut off that auto contribution until the middle of August. So while they might be thinking, oh, I only made $7,000 in total contributions, January through July, in fact, they made 8 $1,000 contributions January through August. They should have only put in $7,000 and instead they put in 8. So super simple math, if we're going to define our variables, which is the excess contribution, the adjusted opening balance, and the adjusted closing balance, the excess contribution in this example is $1,000. They were only supposed to put in $7,000, and in August they put in an extra $1,000, resulting in $8,000 of total contributions. So they made a $1,000 excess contribution. Now we need to figure out their adjusted opening balance and their adjusted closing balance. Now, to refresh your memory on adjusted opening balance, that's the fair market value of the retirement account, ideally the day before the excess contribution was made, so the July 31st balance, plus any excess contributions made throughout that computation period. Now, this computation period, let's say the client is looking to correct their mistake in April of the following calendar year. Well, the computation period is July 31st through whenever in April they're fixing this mistake. Now, fortunately for this example, there's only one excess contribution, but you could imagine had the client continued doing $1,000 a month until April, well, that's a lot of excess contributions they might need to go rectify. And that's a lot of addition they'd have to add to their adjusted opening balance. Simply defined for our purposes, we just need the balance of the account on July 31st plus the $1,000 in excess contributions made on August 1st. To keep it simple, let's say after $7,000 of contributions through the month of July, plus a little bit of market growth, the value of the retirement account on July 31st was $7,500. So their adjusted opening balance is $7,500 plus the excess contribution of $1,000, so $8,500. Now we need to find the adjusted closing balance. The adjusted closing balance, to refresh our memory, is the fair market value of that retirement account on the day in which you're doing this computation, plus any distributions or transfers out of the account that have occurred during that computation period, which would be July 31st through whenever in April we're fixing this. Now, fortunately for the simplicity of this example, there are no transfers out of the account during that computation period, so we get to keep it super simple and just look at the total balance of the account on the day in which we're doing this calculation in April. Let's say the markets are doing great, and now the total balance of this account is $9,000 whenever in April that we're looking at this. If we had pulled out $500 and taken a distribution or transferred it to another account, we'd have to add that back in, but that didn't happen in this example. So the adjusted closing balance equals $9,000, or the fair market value on the day of the calculation. Now all we do is plug and play these variables into the equation and rock and roll. Excess contribution, $1,000. Adjusted closing balance, $9,000. Adjusted opening balance, $8,500. Adjusted closing balance minus adjusted opening balance, $500, divided by adjusted opening balance of $8,500 equals 0.0588. 0.0588 times the excess contribution of $1,000 equals $58.82. Therefore, your net income attributable for this example is $58.82. Now remember, it's not good enough just to pull out your net income attributable. You have to pull out your excess contribution plus the net income attributable. So in this example, excess contribution of $1,000 plus net income attributable of $58.82 equals a total required distribution of $1,058.82. The $1,000 of excess contribution being returned to the client is not taxable. The $58.82 of earnings or net income attributable will be income taxable to the client, and all this will be shown on a 1099-R. The tricky part here is the net income attributable will be taxable in the year in which that excess contribution was made. So in whichever calendar year the excess contribution was first made, that is the year the net income attributable will be taxable in. Even if you're correcting this mistake in 2026 for the tax year of 2025, the excess contribution in this example was made in 2025, therefore the net income attributable being withdrawn is taxable for the tax year of 2025. Now, if the client had put in $7,000 in 2025, then they made an extra $1,000 contribution in 2026, and now in 2026 they're looking to correct that mistake, the net income attributable would now be income taxable in the calendar year of 2026, because that is the year in which the excess contribution was first made. Also to clarify, since like 2023, the net income attributable is no longer 10% early withdrawal taxable. That's a rule that was changed with some Secure Act legislation, so just know that if you're reading that, you're probably reading outdated stuff. Regardless of your age, the net income attributable is not going to be assessed a 10% early withdrawal penalty tax. It's just income taxable. Now let's cover a negative net income attributable example. To keep it simple, let's keep all the same variables from the last example. Let's just say the fair market value of the retirement account in April when we're trying to fix all this is actually $6,000. Let's say the markets were doing great in the prior year, but then January through April, whenever you're doing this correction, the markets took a dump. Going back to our variables, the excess contribution is still $1,000, and that was still made on August 1st. The adjusted opening balance is still $8,500, which is that $7,500 account balance on July 31st, plus the $1,000 in excess contributions on August 1st. Whereas in this example now, the adjusted closing balance is $6,000. Again, no transfers were made out of the retirement account during that computation period. So in this example, to keep it simple, the adjusted closing balance is just the fair market value of the retirement account in April or whenever, this correction is being made. Now we plug and play. We take our variables and plug them into the equation. So excess contribution 1,000 times the adjusted closing balance of 6,000 minus the adjusted opening balance of 8,500 divided by the adjusted opening balance of 8,500 yields us a total net income attributable of negative $294.12. But remember, you don't only withdraw the net income attributable, you need to withdraw the excess contribution plus the net income attributable. In this example, the excess was 1,000, and to add this negative net income attributable, you'll actually take 1,000 and you'll subtract the $294.12. This means for this taxpayer, the total amount needed to be withdrawn from the retirement account is $705.88, which, yes, is less than the excess contribution that was made. Now you might be thinking, oh, well that's good, I have less to pull out of my retirement account. In reality, you lost some money because the markets went down and then you took the money back out. So it's actually not that great of a deal, but it is kind of nice to know that you don't have to withdraw the full thing. So hopefully that was helpful in breaking down how net income attributable works and how the math works. As far as calls to actions are concerned, I'd highly advise knowing what your maximum contributions are to retirement accounts. And in my opinion, if you're uncertain if you're going to violate certain income thresholds, it's a little bit easier just to wait until you're about to file your taxes to make those final contributions once you know what that calendar year income shakes out to be. If you're super confident you're going to be well over the income thresholds for funding a Roth IRA, for example, or you're super confident you're going to be under the income thresholds, then it might make sense just to go ahead and fund the retirement account or do like a backdoor Roth IRA. And I'll link above to an explainer video on that for those of you who are over the Roth IRA income thresholds in the ballpark of like $200,000 plus. But if you do over contribute, Hopefully you'll come back to this video and have a chance to rectify your situation before filing your taxes and before owing the IRS a tax penalty. Hopefully that was helpful. If you have further questions, drop them in the comments below or get in touch on the website. We'll help you get squared away. Have an awesome rest of your day, and we'll talk to you later. Bye.